In today's video, I am going to be breaking down different ETFs that I think are going to be extremely good and amazing buys this month. Some of these are, of course, some speculative ETFs, but others are some pretty solid ones as well. So let's get down and let's check them out. So this first one I am a bit speculating on, mainly because it is an oil ETF. This one is a covered call option, which is going to give you an 8.3% dividend. So that's kind of high, and the reason behind that is, of course, it is a covered call. You're essentially having the shares of oil companies and you're selling call options against them to, of course, bring in an income from those premiums of those options. From there, the volume is pretty solid at 76,000 shares traded every single day. So it's actually not that bad, and of course recently having a massive day in volume. NXF is the ticker, and I personally really think that this could do really well. The reason why I'm saying it's speculative is because oil prices have climbed. There doesn't seem to be any kind of an end to that. We don't have the American or Canadian governments opening up new mining operations, or at least allowing new mining operations for oil, and because of that, basically, I think that it's going to all come down to if Argentina or some other smaller country will be able to pump more oil so that it floods the market, and they, of course, benefit from the higher prices. And of course, we benefit because it will eventually lower prices. The flip side is there is potentially a war over in Russia, which again would raise oil prices. So kind of speculative there. A couple of different things could happen. As we can see, the stock price of this ETF was declining well before the pandemic. However, we have to keep in mind that oil prices were dropping anyways and were really low anyways, mainly because of Trump. And why I'm bringing Trump into this whole conversation is not to be political, it's just because he was allowing a lot of the fracking operations to be he opened up a lot of government land essentially for fracking, and Biden has since closed those lands, and because of that, North America is no longer energy independent from the Saudis, and or OPEC, and because of that, we are now relying on OPEC for their oil, and they are pumping less, and because of all of this, they will be making more money, and we will be spending more money on energy. And I really don't see that changing anytime soon, so I really do believe that this could accelerate to the upside. It does pay quarterly dividends, and if we do look year over year, you have to keep in mind that oil was extremely low back in 2020, so we have to keep that in mind as well. But year over year, December to December, the dividends have raised, and then from 2019 to 2020, they did lower. But we have to remember that oil did go negative for a while in 2020, and that is most likely why the stock or the dividend did go down. Now, the top 10 holdings in this ETF are some pretty strong names. One of the strongest, in my own personal opinion, is Pioneer and Occidental. Those are massive names. ConocoPhillips is another really big famous one. We hear CNBC talk about that once in a while as well. The next ETF is another speculative name. This one is BMO Equal Weights Oil and Gas. This is ZEO in Canada, and of course, the MER of this one is 0.6%, while the last ETF, NXF, was 0.72. The volume is even higher on this ETF as well, and the yield is going to be a bit lower, mainly because it is not a covered call strategy. See, in a covered call strategy, it's going to protect you from the downside. Well, if we're going up, then of course you could still benefit from that big dividend of the last ETF I was talking about, but this one, ZEO, this one is really good because you don't have to worry about the fact that you're not going to have as much to the upside, or you're going to have more to the upside than you would with the other one if the stock market rises when it comes to oil stocks. And 3.47% is still a really good yield. When we look at the 5-year chart, it's very similar to the last ETF where it was going down during the, I'm going to say it, the Trump era. Oil was going down, and of course, oil did plummet during that virus time, and since then, this has absolutely done extremely well. As we can see, remember, I'm going to teach you a lesson right now. This is still trading within its range. It actually never went down during that recent market volatility. It basically went up and then went sideways. There's a reason why I'm mentioning this. You have to be diverse. You can't just say, I'm going to be all in on this one stock or all in on this one sector. You have to own a multiple different amounts of stocks, and you have to have different, basically you have to be basically diverse. That's what I'm trying to get to here. If you own some oil, your downside wasn't going to be as bad. And if we look at the dividends, again, they do pay quarterly. If we look at December over December, the stock did have a dividend increase year over year. If we look year over year, once again, it did decrease just like the last one. Again, mainly because in 2020, it was a very, very tough year for oil, mainly because of the Saudis just absolutely flooding the market with oil to get it as low as possible so that it wasn't as efficient, or at least profitable would be the right word, for the Americans to frack oil and Canadians to use the oil sands. Now, since oil's gone back up, you would expect that fracking and oil sands mining would come back to a massive, massive boon. But we do have the governments who are canceling pipelines, and we also do have the American government under Biden basically not allowing a lot of the government land to be fracked. And whether you agree with oil mining or not, it doesn't necessarily matter. We're just talking about the investment side of things. But when it comes to oil mining, the more oil that comes out of the ground is going to basically make everything cheaper, and they're going to be making less money. So it does make sense to mine less to raise the oil price so that they can make as much money before electric cars do take the market. Once electric cars start taking the market, it's probably going to lower oil prices in my thought process, not because of the tax implications that the governments want to put on it, but mainly because there's going to be less people wanting to buy or needing to buy oil. Overall, 10 holdings that are extremely amazing, and I personally really like Enbridge. That is the one that I love in this top 10. The reason for it is Enbridge is, of course, a pipeline company, but they do more than just that. And if you were to buy any of those 10 stocks individually, I would actually recommend Enbridge over the others, mainly because they are not just in oil. Yes, they do a lot of oil and gas distribution when it comes to oil, when it comes to pipelines, but they are, again, the word diversification. They're diversifying, and they are getting solar panels, they're getting wind farms, they're doing electricity wires. Electrical distribution is the word I am looking for. And overall, they are looking to modernize. I know TransCanada is also doing that, but just not to the same extent. I've done videos of this in the past as well. But let's continue with these top 10 companies. Imperial Oil is, of course, one of the companies that just everybody seems to know. And, of course, another one is Suncor. We all know Sunoco. Suncor in general is a very strong company. And at one time, I did invest in CNQ as well. Next is another covered call ETF. This is ZWK. I've talked about this a million times in my videos. I just absolutely love this ETF. And at this point in time, it does really make me believe that the market is starting to turn over again from the tech stocks that we were just pushing a couple years ago to now being more on the defensive dividend blue chip side, and that's essentially what banks are. And what this ETF does is it holds those banks and runs covered call options against them, and from there you're getting a high dividend, a high yield. Of course, it is taxed differently than a regular dividend because it is a covered call strategy, so keep that in mind. Somebody was mentioning in a comment that it was down to 6%. I'm not too sure where you're seeing that. I'm even seeing 7% in my trading app on TD, so to me, Yahoo does seem to be pretty well accurate. And from there, the average volume is 29,000 shares, so it's pretty good as well. Over the past 5 years, well, you have to remember this isn't a 5-year-old ETF, but either way, it was rising before the whole, of course, pandemic. Since then, it tanked. I was buying it in there, and I think I bought some there, and I was scared, and I held on to it because I trust my instincts, and I bought more there, and I bought more somewhere around there. And then I bought more somewhere, I think around there somewhere. And since then, of course, it just keeps on going and going like the Energizer Bunny. From there, they have recently lowered their dividend, so keep that in mind. But generally speaking, when you're looking at covered call ETFs, you will see a fluctuation in their dividends. It will go up, it'll go down. It all comes down to essentially, of course, how much the company's paying their dividends itself, but also what they can get for premiums on their call options that they're selling. Top 10 holdings. Of course, one of my favorites is, of course, Bank of Montreal, or sorry, I said Bank of Montreal, I meant Bank of America. Bank of America is one of my favorite American banks. They tend to do extremely well, apparently, when interest rates go up. Interest rates are going up right now, so that might be a very strong name in this portfolio. But we have to remember that banks are killing it. They've figured out what to do to make money during recessions. And of course, recessions is something that we just technically kind of had. Some people may disagree, but I believe that we just went through a recession and we may go through another one soon. Who knows? I'm not saying anything. I just kind of think that we might be. But anyways, basically, banks have figured out how to make money. What do they charge you for? Everything. They charge you to hold your money unless you have a lot of it in your checking account. They charge you, of course, MERs on ETFs and mutual funds. They're getting into the ETF market because, of course, why would they allow somebody else to make that money when they could? And then they also charge for everything. Interest rates, for example, they're making a killing. Credit cards, they're making a killing. Everything. Everything. You're going to need a checking account. That's just how the world works. You can't have a job without a checking account. You literally can't run a business without a checking account. Guess what? You're going to need a bank. And even these big banks who are, let's say the small ones up here in Canada, the Tangerine. Well, guess what? Oh, I'll go over to Tangerine. I'm rebellious. I'm staying away from the big six banks. Well, a big six bank actually owns Tangerine. So either way, they own the market. Next is VRE. Vanguard is a great company in general, in my opinion, but this ETF is one of my favorite ETFs, and I personally believe that this specific one could do extremely well. There's a reason for that. First off, it does have a 3% yield. The MER is lower than the others at 0.38, and the average volume is 12,000, which isn't a ton. If you are buying 4 or 5,000 shares at a time, you're probably wanting to get an ETF that might have higher volume. Over the past 5 years, it's done extremely well until the double top, which is scary. But either way, from there, of course, everything's going to plummet during what we just went through, and it has recovered quite nicely, and it's bounced off some support. So both of which are kind of leading me to believe that this could be strong into the future. Of course, because it's a REIT ETF, it does pay every single month. And because of that, I like to really look over the year over year. And year over year, it has increased, which is fantastic. Top 10 holdings is the reason behind I think this is going to do extremely well. 15% of the top, 15.5% of the total holdings in this ETF is in Canadian apartment properties. I'm going to be talking about that as a February stock as well, because there's a lot of things that are going on in Canada, a ton, and it's happening worldwide as well. And it's not necessarily something that I take pride in or happiness in or anything like that, but guess what? Personally, I believe that companies like this who are going to be renting out townhouses, apartment buildings, things like that, they'll do well no matter what. Of course, there's going to be times in which there will be tenants who can't pay their bills. For example, in a recession, you can't pay your bills usually because you usually don't have a job. So those are the reasons why they tend to do not that well in recessions. However, what happens in recessions? Generally, people lose their houses. Well, guess what? When people lose their houses because they defaulted on their mortgage, they can't just go out and get another mortgage for a cheaper house. It doesn't work like that. They have to rent because now they need to build their credit all over again. What does that mean? Well, now those people who defaulted on their houses have to rent, and where are they renting from? Companies like that. So even though there's going to be times in the future where there may be recessions, and in those times, stocks like that will go down, we also have to remember that if they had a good balance sheet, which that company kind of seems like they do, then in the future, those apartments are going to be rented again. And when that happens, they're going to be making money once again. And of course, I have to then go over to VDY, Vanguard Canadian High Dividend Yield Index. The reason for this is because at this point in time, we don't really know which individual stocks may outperform the others. We're kind of going through a weird stage right now where parts of North America are still going to be in lockdown and parts of the world are still going to be in lockdown, while other parts of the world like Florida and Texas, where I have been dreaming about moving and really looking seriously at moving there potentially, they are wide open. So if those states or those areas that are open go back into lockdown, and then it's not going to look so well. However, if the whole entire world starts opening up, we're seeing the truck rally and everything like that here in Canada, then at that point in time, I personally believe that we could have a massive, just market-wide rally, in which case you might as well do that in the stocks that the current market is favoring, which is blue chip dividend stocks, which is what this holds. And that is 3.8% yield, which is fantastic in my opinion. 130,000 shares traded every single day, so it's easy to get in and out of, and 0.2% MER, which is very easy to swallow. And of course, we have seen just absolutely just destroying charts right off the bat. Bang, like, oh my god. However, there is some things that we need to look at, and that is, of course, from up until 2020, there was just basically the market moving sideways. That is because of what this ETF holds. But first, let's look at the dividend, and when we look at the dividend's pretty strong. It's pretty big, really. If we're looking year over year, then we're looking pretty strong. This is, of course, a monthly dividend ETF, which is fantastic, and the dividend has raised about 30% year over year, so that's absolutely fantastic. But again, that leads to why this stock, or this ETF, has been going up so much and wasn't really doing that much before 2020, and that is because of what it holds. The reason why the ETF was able to raise its dividend by 30% year over year is because of the banks, and the reason why the market's been going crazy, at least in this ETF, is because of the banks. What does it hold? Royal Bank, TD, Bank of Nova Scotia, Bank of Montreal, CIBC, and of course, that is 5 out of the big 6 banks. Now, we're also seeing Enbridge, TC, their oil stocks, Canadian Natural Resources, another oil stock that is currently exploding because of the price of oil. BCE, I'm not a big fan of, and Manulife is, of course, an interesting company because now with people going back to work, they're going to be having benefits potentially, hopefully, maybe. And from there, well, guess what? Manulife does a lot of the benefit packages for companies. For example, they do it for Home Depot. So from there, it's just overall a very strong ETF for the times that we are currently in right now. But boy, does that company and Rogers scare me like crazy. They are not looking into the future. Anyways, this is my take on the top ETFs this month. I hope that you have enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.